All right. Thanks, Gary. So first of all, I want to keep this, well, thanks everybody for coming, but I want to keep it pretty informal since we're a small group. So if anybody has any questions, just raise your hand or throw something at me or whatever. But I think, like what Gary said, we've been through, if we had this meeting a couple months ago, the market was in pretty smooth sailing mode, and all of a sudden it got pretty disrupted. So just want to kind of go through what I basically did was make a list of the negatives, headwinds, positive tailwinds. I put the headwinds and tailwinds because that's Wall Street jargon for every time you turn on the financial news, you hear headwind or tailwind. But anyways, there's a bunch of pluses and a bunch of minuses, and I think we're just going to go through them. And again, if anybody has any questions while we're sort of ticking them off, just raise your hand. I think I'll do the negatives first, so we can get depressed, and then we can be happy after we go through the positives at the end of the meeting. I think it's a good idea to start with like a long-term perspective. And this is just what it says. It is a 20-year chart of the Standard & Poor's 500. You can see we've had 5 major, 5 major trend changes in 20 years. They've been pretty pronounced. This is the tech bubble burst, and this is the financial crisis, and this is the last 5.5 or 6 years or so. But what this red line here is the 200-day moving average. And you can see pretty clearly on this chart that the market tends to run in trends above or below the 200-day moving average. Above, below, almost all above. And sometimes it's got blips below, but primarily it's when it's in an uptrend or a downtrend, it's above or beyond, or above or below rather. So unfortunately what we've seen in August is a big break below the 200-day moving average again, which is, it doesn't mean disaster is looming, but it's a red flag, and it means it's a time for more caution. You can see a couple times, this is last October when it broke below, but it went right back up. Some of these V bottoms are pretty unusual, but it's just something to sort of be alerted to, and I think it means basically you have to be a little careful about how you commit money into the market rather than when you're in a confirmed uptrend. Oops. Okay, so this is the same picture. It's the S&P 500, but it's only over 2-year period. So it's a little, you can see it, I just put this up here so you could see it's a little more pronounced in terms of visibility. This is the breakdown in August, really severe. And you can see this blue line is a 200-day moving average. So it's trading below the 200-day, but the slope of the 200-day moving average has also gone negative, which is not a great sign because the 200-day moving average is an indicator of trend. So it's an indication that trend may have changed, and it can change back, or it could be sustained for a while. But you can see this blue line for the last couple of years has been really solid, and all of a sudden, so it's a big difference, and it's a caution flag. So I'm going to start going through the list now, and this is, I kind of put them, if you look at the sheet on the negative side, I kind of put them in order. You can't really order the importance of them, but I try to do it the best I could. And China's in the top of the list because China's really the trigger that started the market going down, and it happened when they devalued their currency. And the market interpreted the devaluation as a sign that the Chinese economy is worse than everybody thought it was, because devaluing your currency, you're trying to boost exports. So the knee-jerk reaction from the market was China's slowing down way more than expected, and that's what really was the trigger that took the market down. This is a chart of China GDP. You can see it was running sort of in the 9 to 10% range, 2010, 2011, and it's been in a slow decline, and now it's probably under 7%, which isn't bad. We'd love to have 7% GDP growth in our country, but it is slowing down. I would just point out that it's been slowing down all this time too, and our market still did pretty well. So my guess is that the reaction to the Chinese slowdown, whatever it is probably overdone. Just like in 2011, the reaction to the European crisis was overdone. So, but that doesn't mean in the short term it can't continue and fester for a while. The other big issue with China is everything that comes out of there is completely opaque. The data they can just make up. The bureaucrats sit around and snap their fingers and do whatever they want to do, so you can't really tell whatever's coming out of there is real or not, and that raises the risk level. The next one on the list is the Federal Reserve and what they're doing. And there's been a lot of talk, as everybody probably knows, about the Fed raising rates. And I think that the Fed has probably done a big disservice to the markets because they've been sort of fumphering around. One minute they're going to raise, 1 minute they're not. The different Fed governors are being interviewed all the time by the media. A guy in San Francisco says we should raise it, a guy in Philadelphia says we shouldn't, and it's confusing. They're not projecting any kind of single-mindedness. This is a chart of the 10-year bond yield for the last 2 years, and you can see it's still been going down, and it's in a downtrend. So the market's really while the Fed's saying they want to raise, the market's kind of telling everybody, wait a minute, rates are still going down. We're almost back to 2% again today. So this is bond yields, by the way, so the yields are still in a downtrend. I just printed this because the Fed's reaction to the financial crisis was to print money. That's what they've been doing, lower interest rates and print money. I think this is Bernanke, the ex-Fed chairman, on $1 trillion bill. Oops. And the issue that's sort of arisen now is that because they've lowered rates so much and printed so much money, they're kind of becoming impotent in a way. There's no more room for the Fed to do anything in terms of monetary stimulus, and they're said to be pushing on a string. So how far can they really lower rates from where they are when they're already basically at zero? And how much more money can they print? It hasn't really had any big positive effect on the economy. This one I just put in because we're on the negative side. If the Fed does raise rates, this is a list of all the market corrections we've had, bear markets, since 1929. Every single one of them except one, the Fed was raising rates. So I think that's a big element of fear that's in the market right now, even though the Fed's only talking about raising interest rates a quarter point, which seems like kind of a rounding error. The market doesn't like interest rates going up. That's a pretty alarming chart. So the good news is that the Federal Reserve has said that they're not going to raise rates very much if they do. So it's probably not going to be a big uptrend where they go from where they are now up, 3 or 4% or something. The other issue with monetary policy is that the dollar's been allowed to appreciate, and since the middle of 2014, it's just skyrocketed. This is a U.S. dollar index against a basket of currencies, and that's a headwind for our market because about 50% of Standard & Poor's 500 company revenues come from overseas. So almost half revenues come from overseas, and when the dollar's this strong, it makes it a real problem. It's a two-edged sword because if the dollar weakens, it could turn into a positive. I wanted to go back to the technical stuff that I showed you in the beginning on the charts just to, it's kind of, when you look at technical analysis, it's kind of like looking under the hood. And I like to maybe use a sports analogy for like the Cleveland Browns. If the Browns win a game here and there, but until the underlying statistics, like for passing complete, interceptions, passing yardage completed and all this stuff tends to improve, you're not going to get a trend where they start winning all the time. And when you have a downturn in the market like this, some of the stuff under the hood that I'll show you, until it starts to get better, it reduces the likelihood that we're going to have a quick recovery in a V bottom where we just get back to the races and everything's fine. So Strategas, which is a research firm that we use in New York City, has this proprietary trend model that they've got, and it turned negative for the first time in 4 years. Again, it doesn't mean it's a disaster because it turned negative here and here when the market rebounded, but here's what happened in 08 too. So it's a tool to use to sort of tell you when to be cautious. One of the things you want to see to feel more comfortable that recovery's coming in the market is the percentage of stocks that are in an uptrend. 2013 and 2014, when we had downturns in the fall, you had high percentages of stocks in an uptrend. We've only got about 30% now. So it's not technically as strong on that basis. You also like to see stocks making new highs. You can see here in 2011 or 2008, when the market finally started recovering, we had a series of expansion highs where the 60-day highs were above, sort of in the 40 to 50 range. We're down at about 15 right now. So until we start seeing more stocks making new highs, the market's not really healthy internally. Another sign you want to look for is momentum. And momentum is measured by the number of stocks that are trading above their 50-day moving average. And you can see you have these surges in momentum where 90 to 95% of stocks are trading above the 50-day moving average before you get a big uptrend. We're down here right now. So we really need to see an expansion in that to feel more comfortably internally. And then the last thing I'll point out before I bore you all to death with technical stuff is accumulation signals. When you come off corrections, you like to see a lot of when the advance decline ratio is very high. This is advancing issues versus total issues, and you like to see it above 90%. There was 14 days with 90% accumulation coming out of the 2011 correction, which was a pretty strong correction. 2010, there was 13 these are the plus marks that you see, 13 90% days. And right now, we've had 2. So we need to see more strong accumulation sign that buyers are back before we feel comfortable. So breadth, accumulation, momentum, those are things sort of under the hood that you need to see that we're really not seeing yet. It doesn't mean they can't come back, but if you want to take positions, you're at higher risk, I think, if you don't have technical signs that are strong. Just one more point that I think is probably the most important. Historically, if you have sharp downturns like we just had, it's very rare for them to go down and V-bottom, come right back up. Usually what they do is go down, come up, and then fizzle to a new low before the whole thing has run its course. This is 2011, big downturn, recovered, kind of like we're doing now, fizzled to a new low before everything was out. Same thing in 98. This is called a bang and a whimper. Kind of bangs down, comes back, whimpers down to a new low. You can make up whatever term you want for it, but same thing in 98, 99, 87. They all undercut their original low. So if you look from a historical context, it's not unrealistic to assume that we're going to fizzle back to a new low. And what you want to look for when you get to these second lows is a smaller number of stocks making new lows as the market does. That's called a positive divergence, and that's a good thing. So if we see that, it was probably a reason to get more bullish, but I would say we've got at least a decent chance of retesting the low that we made in August and maybe going a little bit lower. Energy is the next one on the list, and crude oil's been cut in half. Back here in 2014, you probably couldn't find an analyst in the country that wasn't saying that crude's going to be 100, 110, 120 a barrel. It was a classic case of all the analysts being dead wrong. So it's been cut in half. And oil in itself, it's such a huge worldwide commodity. Even though there's benefits to lower oil prices to us as consumers, obviously, it's very disruptive to the markets when a major commodity like that falls out of bed. It creates a lot of uncertainty. It's harmful to a lot of countries in the world that depend so much on oil revenue. And so it kind of throws chaos into the market. So I think the energy situation is a pretty good headwind for the market, just in terms of uncertainty and nervousness. I just put some charts up here to show you how pervasive it is. This is Exxon, 104 to 80. It's down 24 points. Chevron, these are the bluest of the blue chip oils, 134 down to 90. It's down 44, 45 points. Occidental, all the charts, they were all painted with the same brush. They all look exactly the same. Politics is next, and I defaulted on politics just to cartoons because that seems kind of what it's like. I'm not taking position on either side of the aisle, so I've got one cartoon for each side. But the political situation right now is on both sides is just sort of so disjointed that I think Wall Street doesn't like uncertainty, and when you don't have any clue who the next leaders are going to be, that's an uncertainty, and it's almost like a circus right now. So this is Bill. I like this one because Clinton's got a big cheeseburger here at the dinner table, but he's saying, cheer up, Hillary. Nelson Mandela was in prison for 27 years and he became president. So, and then this is the GOP side where they've got a disgruntled elephant with no speaker in the chair. So they've got problems on both sides. In the credit markets, we've had a big surge in credit spreads, which means that high yield, corporate America it's more costly for them to finance their businesses. And when spreads accelerate like that and expand, it's historically been a pretty bad thing for the market. So we really need to hope to see that these credit spreads calm down a little bit, or maybe even start going down before the market gets better. And then liquidity has also been an issue. Kind of goes hand in hand with credit, but the Fed's pumped all this money into the market, and nothing's really. This is the velocity of money, and it just continues to go down. And what it means is banks aren't lending as much, probably because of all the regulations. And the demand for borrowing isn't really there either, because people are so leveraged, they don't really want to take on a lot more debt. So the credit markets are they're not dysfunctional. They're not frozen like they were in the financial crisis, but they're not operating real smoothly. So you would think from this chart that just at some point the velocity of money's got to start to pick up. The last piece on the negative side, and then we'll get to the positive, is sentiment. And sentiment's like an inverse indicator. So when people are feeling really good about things and everybody's bullish, that's a bad sign. This is the world of the stock market for you. When people are feeling horrible and worried in the extreme, that's bullish. That's actually a good sign. So down here, this is just the percentage of investors that are bullish. And you can see again that it gets very low, down about 25% or so at some of these downturns. And now we're only at we're 40 to 45 now. So there's not that many people really feeling horrible about the markets or the economy yet. And usually that kind of has to wash itself out before we've hit a bottom. This is just anecdotal stuff, but a lot of the headlines recently, especially after this is August 25th, so right after the turndown, anybody's saying don't sell, avoid the panic. It's this widespread stuff in the press telling everybody to stay put and not worry. Even ESPN, the sports channel had a comment on the stock market. Worried about the stock market, whatever you do, don't sell. So that stuff's all actually bearish, because when you see the media being all really positive like that, it's not particularly good. Strategists goes around the country talking about the market, and they always do surveys of who they're speaking with. This was end of September in New York City, and the question they asked was, is the next 10% move in the market going to be higher or lower? Almost 80% said higher. Again, that's positive sentiment, which is not a really good sign. Because when you get a crowd going one way like that, they're usually wrong. This is the world we live in every day. So that kind of wraps up the negative side. Anybody have any questions on any of that? It's a lot of technical stuff, I know, but it's just...
Do you have any thought about where the dollar's going? I mean, is it going to keep going up, or you're going to see some weakening?
They say that the predicting currency movements is 10 times as hard as predicting the stock market movements, but I would guess that the dollar is going to calm down a little bit. It really hasn't done that. People feel like it's still been going up all year, but on that chart you saw it's mostly been flat to actually declining slowly this year. So I think it's gotten to a pretty good extreme, and it would be a really good thing if it reverses itself to some degree. Oops.
Question. How about some of the global turmoil, or is it not enough at this point to really impact the market?
No, I think it is impacting the market a lot. I mean, particularly out of China, but all the emerging markets have done horribly for the last few years, and it's mostly because they're very commodity-based countries. Even Canada. I mean, they're reliant on commodity prices, and commodity prices have collapsed right across the board. So
outside of China, are there other areas? I mean, the things that we're seeing in Turkey and Israel and all those other places, is that an impact?
I think the geopolitical, I should have touched on that actually when the political / geopolitical component of it I forgot about is all these, Syria, ISIS, Israel, I mean, everywhere. You've got these hot spots, and the fear, of course, is that they're going to expand and create more chaos. So yeah, I think that's a headwind, but it changes so fast that it's hard to measure, because that can turn into a tailwind too if things calm down.
True.
But yeah, I think it's a big concern. The whole idea of the smaller world now, everything's intertwined. So that's why our market is more reactive to what's happening around the globe. So on the positive side, I think the two biggest things that are positive are the U.S. economy and valuations. U.S. economy is really on pretty decent footing, even though it may not feel that great. I think a lot of the news that we hear all the time is very negative, and it's probably better than, the news is sensationalized, so we're always hearing how lousy things are. But GDP, even though it's lower than it's been historically, this was 1980. I mean, that's a long time ago. It's still running 2.5% to 3%, which isn't all that bad for the biggest economy in the world. We've got unemployment numbers way down. We've got income numbers starting to grow. Productivity, historically, we've been the most productive country in the world, and I think there's every reason to believe we're going to continue to have that, have really strong productivity going forward. So there's a lot of positives in the economy. I think housing is also another big one. Housing data has been phenomenal lately. In fact, there's like a shortage of 500,000 construction workers now. So doesn't feel like it in Cleveland that much. But if you go to some other cities, I mean, it's amazing. And then another big point that I have on the sheet is the government has been, with all the sequester and the concerns about spending levels in the last few years, that's kind of over now. So we're sort of at the end of sequester, and that's been what they call a fiscal drag. And that fiscal drag is going to turn into a fiscal push, probably to the tune of about 1% of GDP in the next couple of years. So the government's going to be helping again instead of dragging GDP down. So the U.S. economy is really, it's definitely the best house in a bad neighborhood when you compare to the rest of the world. But I don't think it's as bad as everybody feels like it is. This is just a chart on productivity. This spike here back in 2004, 2005 was unusually strong. But with technology evolving like it continues to evolve, I think it's really easy to expect this to head back up towards the 2% range. And another thing that'll drive that is when businesses start feeling more confident about the economy and spending, because they're kind of locked up now, sitting on huge cash balances, that'll drive productivity because it drives entrepreneurship. So I'm pretty optimistic about productivity, and that's a big tailwind. It's a long-term tailwind. This is a chart on valuation, and you hear a lot about the market being over, again on CNBC, probably every day you can look and see something about a bubble. But in the stock market, there's really, I think, almost no reason to argue that there's a bubble. Things aren't particularly overpriced. People feel like there might be a bubble because we've had a 5-6 year rally. But you really have to relate the price earnings multiple of the market to the inflation level. And when inflation gets above around 4% or so, PE multiples really start to contract. Inflation's a bad thing for the market. We're only at about in the 0 to 2% inflation range right now. And going back to 1950, when inflation's at where it is now, the multiple has been, in the 17 and a half range. Right now, the multiple on our market, this is according to FactSet Research, is 15.9. This is all the different sectors, but this is the S&P 500 right now. So we're actually a little bit below the historical multiple given the inflation levels. I'm not saying that the market's really cheap, but I don't think you can make a very good argument that it's expensive. The one concern would be operating earnings have started to, the projections for operating earnings and actual operating earnings have started to flatten out. So we really need to see that probably accelerate before we would have dramatically higher prices in the market. I think someone asked a question about the dollar. The U.S. dollar declining would be a big boost for that, for operating earnings, because again, half the revenue is coming from overseas. This is just one little sort of niche slide I want to throw in here. Curiously enough, even though there's a big thirst for income because people can't get it out of the bond market, income-producing stocks haven't done that well. And right now, over 40% of stocks in the S&P 500 are yielding higher than Treasury bonds. So it's a pretty good deal to buy income stocks right now relative to history. Look how low it was here. And it's really expanded. So if people are looking for income, it's even though you have to have a little bit stronger stomach, it's better to buy high-yielding stocks and have some potential for appreciation over the long term than to buy, relative to buying treasuries where you basically get nothing. Just a couple little caveats, and these next two charts aren't anything about the market going down. It's just sort of about setting expectations, because I think over the last 5 years, with the market going straight up, everyone's expectations have sort of gotten out of line. You think it's going to go up every year. The market doesn't go up every year. When the market's trading below its 200-day moving average like it is now, these are the pink bars are the forward returns, 3 months, 6 months, and 12 months. And you can see they're quite a bit low. They're still positive, but they're lower than they are when the market's in a confirmed uptrend. So to me, that just says people should kind of lower their expectations, at least in the near term, about what the market's going to give. Doesn't mean you have to run and hide, but it's not really realistic with that kind of chart. That goes back to 1928. So it's not realistic to expect great returns in the near term. And then also, this is just the same kind of chart, except it has to do with volatility. When the market's below the 200-day moving average, volatility, intraday volatility is much higher, which we've seen, almost 2% a day intraday. So I think, in other words, you have to kind of have a tough stomach and just look the other way when we have these wild swings, because that's just the way it is. One of the important factors, it's a really big positive, I think, is this idea. It's this acronym TINA, which stands for there is no alternative. And what it means is, since rates have, the central banks have pushed rates down so far, there's really no other choice for investors, particularly retirees who are looking for income, to go anywhere else besides stocks. They kind of don't want to go into real estate, because real estate is illiquid and got so busted in the financial crisis. Bonds aren't giving anything. You can't go find a CD for 5 or 6% anymore. And it sort of leaves the stocks with a dividend and some appreciation. This is a really interesting chart. Institutional investors, endowments, and pensions used to have, about 15 years ago, about half of their portfolios invested in stocks. And Yale University started moving their endowment towards alternative investments, and they were very successful in the early days, so everybody started, lemmings off the cliff started following. And it's gone from 50% to about 36% exposure in stocks now, where alternatives have gone from 24 to 51, so it's completely flip-flopped. I would argue that there's a really, really strong chance that this number is going to revert to the norm and start going back, maybe not to 50%, but start going up, and that's a huge tailwind in demand for big institutions to start buying stocks more. And you've already seen some of these pension funds getting out of private equity accounts because they're not getting the returns they were promised. So the alternative spectrum here is very expensive to invest in, and it hasn't generally produced results that were promised. So at some point, there's going to be a swing back towards equities, and that'll be huge demand driven. On top of that, most people don't realize this, but the outstanding number of companies listed on the exchanges has shrunk unbelievably in the last 15 years or so. 8,800 stocks, now there's 5,300. So we could be in a position where there's a lot more demand for stocks chasing fewer shares, and that would be a huge driver. I think if you asked 100 people about that, nobody would know it. Corporate balance sheets, just to touch on that, are in much better shape than they were in the last two big downturns. This is debt as a percent of equity, and it's just plummeting down. So corporate America is in really good shape right now. Cash balances are high. They're not investing their money. They're buying back stock, and they're looking for M&A, but they're not making a lot of capital expenditures, which is keeping things from really growing. But at least they're in better shape balance sheet wise, which is a big positive. The last point on the positive side is seasonality. And again, I think this is something that a lot of people don't realize, but there's a huge seasonal component to the market. August and September are the worst 2 months. This is data going back to 1950, August, September, and we sure saw that this year. Those are the worst 2 months. The good news is, and this is why I put it as a tailwind, about mid-October it starts improving. November and December are really the best months all year. I'm not sure why, but it happens a lot. So we've got a tailwind in seasonality coming. So that's pretty much it on the positives, at least the big ones that I see. And I think I think we're basically in a position where the market, there's enough positive reasons to think that we're not in danger of another big downturn like 2000 or 08. And I think people tend to look back and say, okay, are we in a bubble like we were in the technology in 2000? We're going to have another financial crisis like we did in 08. And I think if we do have another big downturn, it's going to come from somewhere else. It almost never comes from this. It's not going to be a tech bubble. It's not going to be a financial crisis. It might be geopolitical or something else. But usually what's happened historically isn't the thing that makes it happen next time. But I think there's enough positives out there to be optimistic that we're still in the long-term uptrend. But in the near term, I think people just have to really settle down and realize that they're going to have to kind of wait it out sometimes. And that's what you have to do in the market. And saying be patient to people is an easy thing, and everybody nods their head and says, I'll be patient. But when things get chaotic, it's hard to do. But I think there's a lot of data here that shows it's reasonable just to kind of sweat it out and wait for these things to, sometimes the market just has to go through these digestion periods and get through it all. So we also said we'd just do a little review of some of the sectors, and I thought there's 10 sectors. I'm just going to talk about 3 of them really briefly: energy, financials, and healthcare. This is just a chart of the energy ETF, and I just wanted to show it because, it looks just like all the charts I showed you on Exxon and Chevron and so forth. It's really been beaten up. But the thing about it, particularly with commodities, is that when you get a big downturn like this, a lot of people think, I got to buy now because it got creamed, it's going to go back up. And particularly with the volatility of oil, people think, I got to buy. But the truth is that when you see charts like this and major moves like this, the thing that usually happens before they just rebound quickly is they either go lower, but what usually happens is they consolidate for a long time. And as examples, in the tech bubble, it took technology stocks years and years and years to recover after that burst. The financial stocks, the same thing. In 08, it took they still haven't recovered that well. So it takes a long time, usually when you have a sector that gets decimated, to recover. So I don't think it's a particularly good idea to jump in with both feet to energy stocks. They're good, they're decent for yield, but their earnings are depressed now, and they probably will be unless we get a huge rebound in oil, which is unlikely. On the other side of that, you do see ads like this, which they're putting out exchange-traded funds now, S&P 500 without oil, because they know they can sell them because nobody wants oil right now. So that's actually bullish for energy. In healthcare, it's really, I'll go to the second chart actually first. Healthcare has really taken it. This is the biotech index, but the healthcare pharma index looks just the same. It's broken down after a huge long uptrend, and so it's kind of gone from leadership to lagging. And in this recent 2-week period where we've had a rally, healthcare stocks have not participated, which is which is alarming. It's really a red flag. Interestingly enough, back to analyst recommendations, out of all these groups, industry groups, biotech and pharma are the most highly rated by Wall Street analysts, and now they're breaking down. So I would say this is bearish. When the analysts are all going one way, they're usually wrong. There's a lot of data that's unbelievable to show how wrong Wall Street analysts are. So the healthcare sector isn't looking very good right now. And then finally, banks. On the positive side, commercial banks have also been underperforming recently, and I think that's mostly because the Federal Reserve did not raise rates. Everybody was expecting to raise rates because they said they were going to, and when rates start going up, that's good for banks because their spreads widen. So they've kind of been flat on their back. But banks have, as far as their earnings weight in the S&P 500, financials make about 20% of what's earned in the market, but their weight's only about 16%. So, in the long term, those should at least be somewhat equal. So there's probably a good tailwind for banks in terms of the future. And I think the financials are probably an opportunity here. And also the Fed has painted themselves into enough of a corner where they probably have to raise rates at some point. So looking at those three sectors, I would say the financials are a better opportunity than energy and healthcare right now. So that's pretty much it. If there's any questions.
Going back to when you mentioned, if I understood you right, we have approximately 3,500 fewer traded companies over the last 20 years. Where'd they go?
Mergers and acquisitions, mostly.
Okay.
There's been a lot of it. M&A activity has been really high.
Any leave the market totally? I mean, there certainly are some just being bought out, like private.
Right. Well, if one company buys another, that's two that becomes one, right?
So what if it wasn't? I'm saying the purchaser isn't publicly traded to begin with.
Right. Then that just takes, yeah, that's only publicly traded companies.
Pick on a Lubrizol, for instance, and
Yeah.
it just disappeared.
Right.
So-
Yeah, exactly. It's been happening consistently. So yeah, it's amazing how much shrinkage there's been, and there's a lot of things in the market now that we didn't used to have that are also affecting prices particularly on a daily basis. The volatility that we've seen looks like a lot of it was driven by exchange-traded funds, because in the old days everybody owned mutual funds, and mutual funds only trade once a day. So at the end of if you sell at the end of the day, you get sold out. But there was nothing during the day that indicated to everybody that everybody's selling. With exchange-traded funds, you push a button just like you do with a stock to sell or buy. And when the selling pressure starts hitting, everybody sees it, and it feeds on itself, because there's all these algorithms, that mostly in New York, that are driving these short-term trading strategies. And so it feeds on itself. So when you see these huge downdrafts, you really have to kind of step back and say, it's probably not that important, because it's more technically what's happening with selling pressure driven a lot by computers and algorithms than it is by reality. So hopefully the SEC can sort of get their arms around that and maybe put some measures in place to make it a little more, make it sort of smoother during the day, like it used to be when the uptick rule was in place. So it's a fast-moving world. Yeah.
What role does our debt play in all these numbers?
I think it's a great question. I think the spectrum of debt being out there at such high levels, not only in the U.S. but in Japan, now in China's debt's exploding. It just makes it a lot more. It's like having too much household debt. One thing goes wrong and you got real trouble, right? So it's no different. You've got elevated debt levels everywhere in the world. There's less wiggle room. So I think it exacerbates any of these problems that might not be that big a deal, are exacerbated by the debt levels, because there's not as much, I mean, in the financial crisis, what basically happened was all the private sector debt got pushed onto the government. It's still there. It's just that the government can kick the can down the road more than corporations can. So that's a big negative, but it's not when things are going well. It's just when things start getting like this, and that's another reason I think we see this volatility. But I went through a lot of negative stuff this time, which is probably not that exciting to hear. But in the short term, that's sometimes what happens in the stock market, and that's what we're facing right now. So I'm just really throwing that out there so everybody can set their expectations. It doesn't really have anything to do with the long term in terms of where we can go in the market. Some of these things iron themselves out. You can go down that negative list, and almost all of those can become positives if certain things happen. Fed raises rates, we kind of get that behind us. Maybe a month from now we get some good economic news from China. Market will go straight up. All those things can reverse themselves.
That chart you showed before, the alternative investments growing to 50% for the private the investors, what does that include?
Alternatives?
Yeah.
I'm not sure exactly what's in that bucket for that chart, but it's mostly private equity. That's exploded.
That's not something that Carnegie has access to, or do?
We don't know. We don't really. I mean, do we put in?
It just seems like a huge number for the best investors in the world to grow to that percent.
Yeah.
To not participate.
Yeah. Well, I think what's happened is that private equity is sold. I think there's been some obviously great private equity deals, but it's sold kind of on a long-term basis with high return expectations, and it's very, very expensive to own. That's why the number of private equity firms has exploded, because guys can make a lot of money, people can make a lot of money. But what's the experience of the typical investor in private equity isn't uniformly great. In fact, a lot of times it's, you wait 10 years and you find out you got a 2% return or something like, and you've been paying through the nose along the way. So a lot of these boards of these big pensions and endowments are sitting around analyzing what they've done, and they can't justify the expense or the return. So there's been a lot written about it, and I think particularly in California, they're all starting to roll already, where they're saying, we're firing those guys, and we're going to get back into, so the allocation to stocks will probably start to go back up, and who knows how much. But
I know you don't have a crystal ball, but what is your outlook for 2016?
for the market or the economy?
Yeah.
Yeah, I mean, the outlook for earnings is for some reacceleration in operating earnings, but probably not enough to, it's kind of benign, I hate to say it, but it's probably not enough to expect really high returns out of the market, but it's not bad either, so it's not enough to say.
You feel the market's going to be pretty flat for the next.
I think there's a decent chance that it could be pretty flat, but
it's going to have its ups and downs,
yeah.
but they'll remain relatively flat.
Well, yeah, and I think the biggest issues are what happens with the U.S. dollar. I mean, for our market, that's a big thing, and also what happens in the emerging markets, like you asked about in China. If this China fear is overdone, which usually when we all get fearful, we're overdoing it, right? So I think there's a decent chance of that. If we get good news out of China, where they're growing a little bit faster, then that's a different story. So there's a lot of moving parts, but on an earnings basis right now, the way things look, I don't think it's not really strongly one way or the other. All right. Thanks for coming, everybody. I hope that shed some light on things. I know there's a lot of moving parts.